Sandeep Tandon joins us. Sandeep, good morning. Thank you for joining us. I read a CLSA report in the morning, and the CLSA report is claiming that Indian markets are trading at a 35 to 40% premium to the historical averages. And when that has happened in the past, Nifty either gives a negative return or gives no return for next 12 to 18 months.
So I think we should not look on just one parameter, So we as a house, we also believe in looking at in totality over our VLRT framework. So we try to look at valuation on one aspect, but liquidity is equally important and risk appetite is equally important. Okay, so we like to take a call on the combination of these three factors rather than just looking on the isolation of pure valuations. That will not give you answers. So is the case in March 2020, people were worried, and you see risk appetite was low and liquidity was at 52 weeks high, and we saw what's a massive bull run which unfolded in last 9 months. So the way I look at this market is that let's look at the three larger picture, okay, for 2021. The first big call is where dollar is heading, okay. Now it has become a very consensus call that dollar is going to collapse, okay. So from a longer term perspective, I agree dollar is heading down. But from a very near-term perspective, when I say near-term perspective, it could be a quarter perspective, okay? There's a high probability that dollar index will not break 89 and can rebound from these levels, okay? Whether it will sustain above 92 or 91 levels or so or not is difficult to pinpoint at this point in time. But if dollar index reverses, okay, which I will say is a high probability given the complacency which is there in the global equities, okay? And that is very disturbing. If you look at the Quant complacency indicator for US market is nearly at 40 years low, which means people are extremely complacent. And whenever we see these signs of complacency, it leads to a volatile environment. So I expect that next 2-3 months can be more volatile given the background which is being created. And if I look to the combination of commodity prices, expectation of rising inflation coming back in a big way, this is a combination we have to look at. And with that background, I will say longer term, extremely good for Indian equity and emerging market. But maybe from a very near term perspective, I will say correction, consolidation sort of phase will come in next 3 months or so.
Okay. Would you buy into the current risk-on mode which markets are going through, cyclicals, PSUs, metals? Do you think this is just a deep swell or this could be a trend in making for the better part of 21?
Okay, if I have to look at, again, larger perspective with what we talked about last time also when we talked about how metal and cement are our key themes for the last quarter, we discussed about it. But given the background, again, I will link with dollar index, okay? See, dollar index from a longer term perspective, if I say till 2023 is heading towards 65. With that background, commodities in general looks extremely good, okay? So it's a medium to long term, extremely positive on commodity cycle as a whole, whether you talk about cement or you talk about metals in general, very constructive. When I come about from a very near term perspective, a quarter perspective, I'll be cautious because dollar index is at the inflection point. If it reverses, then metals can see deeper correction because they have rallied a lot in the recent times. So I will like to be very cautious. I will not like to participate at metal at this level. A quarter back, I was very bullish. From this level, I will prune down my exposure and wait for an opportunity to rebuild in next 1 quarter or so. That's the way I will play metals. As far as value stock is concerned, deep beaten down stock is concerned, or neglected territory stocks is concerned, we remain very constructive for that because we believe 2021 is an area where massive wealth destruction can happen globally. And with that background, all beaten down stock has potential to revive, okay, given the rising liquidity and rising risk appetite for emerging market and India in particular.
Sure. Sandeep, where within the market right now are you finding comfort to buy afresh and add positions at even these elevated levels?
Okay. See, what is exactly happening, people are playing on events. So if you ask me, this is the quarterly numbers are expected or I'm going to expect it started from next for coming Friday itself. So people are playing right now for the quarterly numbers. So they talk about IT, FMCG and pharma. These are the three sectors where we expect better quarterly numbers. So people are preferring to park their money. We have seen sector rotation happening very quickly nowadays. Okay, given the volatile environment, sector rotation, stock rotation is very quick. So we'll see opportunity there, and that's the reason we have seen in IT sectors or IT stocks have rallied a lot. I think this phenomena can last for another 2 weeks time, and then you see some amount of rally in IT will fizzle out, and then they might move towards pharma because the results are expected. So if I have to break these thesis from a longer term and a near term perspective, see, from a longer term perspective, I think it's still a risk off environment globally. Okay, with that background, IT, pharma, FMCG as a theme, defensive as a theme will continue to last for next 3 years perspective. But you will get these short term, near term cycles also where you will see risk on and risk off environment, and based on that you will see sector rotation. Okay, so we like to participate. That's the reason we advocate in a dynamic way of money management rather than buy and hold strategy. Those strategies will not be very effective till 2023 because we believe from 2018 till 2023 global equities or global asset class classes will remain very, very volatile, and that's a trend we are seeing. You know, the swings are so massive. Okay, and we are not able to gauge. And look at the way Bitcoin has rallied. It's a clear signs of what is the level of risk appetite global market had. Okay, and with the recent correction also in Bitcoin, also indication that risk appetite is also peaking out from a near-term perspective, and that is not a great news from the risk on environment point of view.
Sure. Sandeep, the one pocket which is not really, giving you very comforting signs is banks. If I look at the annual performance of how some of the other sector indices, how the Nifty has performed, vis-a-vis what the Nifty bank has done, it's underperformed. Even if I were to pinpoint individual cases, the darlings of the street like an ICICI Bank, which even pre-COVID was a consensus buy call for everyone and continues to be so, that's given you only flat returns or mildly soft returns on a year-to-date basis. There's only Kotak Bank and HDFC Bank which have managed to hold out while the rest of the banking pack is underperformed. Yes, sporadically you are seeing some of the PSU banks turn up, some of the other smaller banks as well within the private lot participate, but you're not really seeing a secular move. A, what explains that? And B, within the banking pack, do you think time has come now to bet on some of the underperformers?
So one thing is very clear, right from the March correction, we have not seen any under ownership scenario for the bankings. Okay, majority of the funds, majority of the family office continues to remain extremely bullish on the banking space despite massive underperformance which we have seen. Okay, so if any sector which is remain over-owned for a longer-term perspective tend to underperform in the environment which we are currently, and hence I believe the underperformance of banking can last for a longer period of time. I'm not talking about individual names, but as a sector, whether IT can outperform banking, answer is yes. Whether FMCG and pharma can outperform banking, answer is yes. And I'm not talking about 1 quarter, I'm talking for next 3-year perspective. As far as value stock is concerned or beaten down is concerned, I think that is the theme from a next 2 or 3 years perspective. I think all over-owned, overvalued, okay, or what I call it most admired category, stocks which are in the most admired category have done very well. That cycle is speaking out. This is the phase to identifying neglected, under-owned, beaten down names, okay, and under-owned stocks. This is a cycle, So next cycle belongs to such value investing, and it's not only India, it's globally it is picking up. So maybe PSU banks has potential to outperform the private sector bank as a whole. But again, private sector banks, many individual names are very, very good. So we are not talking about bearing those 2-3 names. Overall, banking as a space has potential to underperform from a longer term perspective.
Sandeep, what market has, in a sense, been voting for a periodic bounce in beaten down PSUs or metals or cement or cyclicals, but they continue to still back the classic compounders, whether it is Kotak, HDFC Bank, whether it is Asian Paints, or whether it is TCS or Infosys. Do you think that is what we should focus on rather than getting carried away by these flushes or these seasonal trends in cyclicals and in industrials? Focus on where the corporate earning and the needle is likely to move and where the market share gain is happening?
So, Nikunj, there is no answer in a straightforward manner. The way we look at, we have seen in this environment, people tend to chase a particular sector, okay, or money chases particular sector or particular philosophy, okay. With that background, you have to keep on switching, and based on the risk of environment, you have to keep on adjusting your portfolio in such a manner that you don't miss out even these short-term opportunities, because these opportunities are big. 15, 20%, 30% moves which comes in let's say in our next a month's time or so. It's a very, very sharp or deep opportunity you cannot afford to miss from the current levels. So I will not go so in terms of this admire category that everything. The way I look at the larger picture is risk off. Okay, that's a next many years perspective, is that for next 3 years perspective is the large picture. We are talking about uncertain environment. We are talking about wealth destruction phase. We are talking about money shifting from developed market to emerging market. With that background, I would like to be very cautious in some of these expensive names which you talked about, okay? And these are grossly overowned. So I think the risk in these stocks are much deeper as compared to beaten down, neglected territory stocks based on the opportunity which I'm talking about from a dollar index perspective or US 10-year yields perspective, or even from the VIX perspective. So I will look as a combination and then try to identify particular sector or stocks from both from the near term and medium term perspective. At this stage, I'm not looking at stock from a longer term perspective. Okay, we like to concentrate on the portfolio from near and medium term perspective. Given the dynamic environment is changing, okay, is very premature to talk about 5 years and 10 years horizon from in the current environment.
Okay. So for next 6 months, what are your outsized bets? Since you are insisting that you are very dynamically managing a portfolio and that should be the mantra going forward, let's understand that where are you positioning your portfolio apart from banks to be overweight and to capitalize on the global, the global lay of the land?
So if I look at, let's look at just 1 quarter perspective on immediate basis. That's the way where our concerns are right now. We believe that easy phase of liquidity is peaking out. So we are not saying that global liquidity is peaked out. Okay, the way easy phase is over, global liquidity will remain extremely good from a medium to longer term perspective. Risk appetite in most of the developed markets are also peaking out from a near term perspective, and we expect, as we talked about, that people are very complacent about global equity. So market can become more choppy, and I expect VIX to move off from a next near 3 month perspective or quarter perspective. I like to remain extremely cautious of, as breadth parameters are also peaking out. Not many parameters which we track very showing. I'm not using the word signs of euphoria, but it's showing a signs of complacency. With that background, I expect market has potential to correct and consolidate for the next quarter perspective, and hence we have position our portfolio towards IT, FMCG, pharma in a big way. It's a defensive space, and remaining portfolio will like to play depending on the short-term and medium-term opportunity. So focus is to preserve the capital at these levels, and the money is already shifted. The way you look at FMCG, okay, the sector was sleeping, people have ignored it, people have shifted from FMCG to other sector. Money flow is clearly demonstrating that next bull run can happen in the FMCG also. So that's a space which we are positioned right now, okay, and it is not a consensus trade. So we generally don't play consensus trade.
FMCG? Did I hear you say the next bull run could happen in FMCG? I'm asking you again because I heard you say that the next bull run could happen in FMCG.
Yes, selective stock answer is yes. Okay, because if I have to look at the longer term perspective, So if I have to take a call next 3 years belongs to Asia in particularly, Asia-centric emerging market. Theme is not DM, it's all about EM. We have seen outperformance of DM in 10 years. And from a data points, because of a lot of predictive analytic tools are endorsing the Asia is the focus area. Money will shift from DM to Asia in a big way, and India in particularly. And when we talk about India, then consumption stock, India-centric stocks will also do very well. And that's the reason despite concerns on dollar index from a near-term perspective, we remain very constructive for cement and steel also from a medium to longer-term perspective. And consumption stock particularly, I'm not talking about most admired and over-owned FMCG names, but there are many such names which is available in the market, which will qualify for a bull run.
Sure. Sandeep, what about the whole cyclical basket as well? What's the opportunity there as you see it with pockets where we have started to see activity building up? Do you feel it's still too premature?
So, as I said, our view on the dollar index and the commodity cycle is extremely positive from next 2 or 3 years perspective. So we remain very constructive for the entire metal as a sphere of commodities in general. But from a very near-term perspective, we have seen a very decent rally in these names. And if signs of reversal for dollar is there, okay, and hence I like to play in a very cautious manner, okay. I like to see next 15-20 days move by maybe in January end on higher side how dollar index performs, okay. If dollar remains weak and has a potential to break 89, then the rally in these names can continue. But probability in terms of looking at multiple data points which we track closely, it looks like that we are on the cusp of a reversal from a near-term perspective. So near-term perspective, metals cautious, okay, from medium and long-term, extremely positive.
Okay, fair enough. And in terms of, the kind of participation we're likely to see as well. I mean, you mentioned earlier selective names. Would you still limit perhaps picks to leaders across certain segments, or would you actually, actually broaden that view to seeing more participation from quality mid-caps, small caps as the recovery picks up steam?
So if I have to look at the larger perspective, and they have predictive analytic tools are endorsing that next 2 or 3 years, if you're talking about the emerging market rally, then it will be much more broad-based rally rather than concentrated rally, which we have seen so far. And I expect, and maybe after a quarter or so, I expect this rally can become much more broad-based rally for both small and mid-cap perspective. And I strongly believe that mid and small has potential to outperform large cap names if I have a 2 or 3 years horizon.
Okay, Sandeep, great to have you on the show, and wish you a very happy and prosperous year ahead.
Thanks a lot.